Hello and welcome to Investing with Beauchamp and Bright, and a happy new year to you all. I'm Chris Beauchamp, UK Chief Market Analyst. I'm joined as ever by Aaron Bright.
Hi Chris, how you doing?
I'm very well. How was your new year?
It was nice. Managed to get a little bit of time off, but still busy. I was doing a lot of work over the break, so I didn't have the full time off.
Well, you had to catch up from your extended holiday in South America.
I did. Was getting over the jet lag and just recovering.
Yeah, exactly. And we have a guest today, our first guest of the year, starting the podcast off on a strong note for 2025. I think you should introduce him, Aaron.
Yes, so we're delighted to be joined by Joe Little, who's the Chief Investment Strategist at HSBC Asset Management. How are you, Joe?
Hi, thanks a lot for having me. Great to be here. Looking forward to the chat.
Yes, pleasure. So just a little bit of background about yourself. How does one become the Chief Investment Strategist of HSBC?
Well, I mean, I started off like many people working in a similar role, I suppose, by doing economics, and then was a bit torn whether or not to pursue a career as a policy economist or head into markets. And the siren call of investment markets, financial markets was too much to resist. So I've done a variety of roles, but I've always been looking at markets from that top-down perspective, as a sell-side analyst, as a hedge fund manager, and more recently as a buy-side investment strategist. So yeah, always been focused on macro markets, top-down investing, and really just sort of focused on my kind of key interests. Do something you love and you never work a day in your life. That's what I was told when I was a kid.
Absolutely. I think that's good, and it's glad that you do something that you love. No, absolutely. And you know, it's been probably quite a busy time. Definitely the past sort of 5 years have been quite busy for markets.
You can say that.
Yeah.
The roller coaster we've been on.
Yes. 2019, I'd say, in particular.
Yeah, little did we know what was about to happen.
Absolutely.
Really.
Absolutely.
Bad time.
But I mean, given all the volatility, I mean, what we were saying last time, Chris, just sort of mid-December, is 2024 pretty good if you're looking at sort of most equity markets.
Astonishing, yeah. Certainly for the US in particular.
Yeah.
I do keep a list to try and keep a sort of bookmark list of predictions at the end of every year. Right. And there was a nice one from, I won't name them, but they said, 2024 is not going to be a good year for stock.
Yeah.
Yes.
And it was because you came off the back of a strong year in 2023. Yeah. You'd had the rebound and recovered.
Yeah, I mean, going into 2024, most year-ahead outlooks were quite pessimistic. And I was a little bit pessimistic going into the year, given the amount of sort of rate hikes which hadn't, come to fruition yet. I mean, was that the sort of view from HSBC going into last year, or was there sort of an element of positivity?
I think most economists felt that way.
Yeah.
And for justifiable reasons. But as always, investment markets are responding not just to the data flow that is received, the news flow around rate cuts, active fiscal policy, resilient growth, resilient profits, but also the fact that there was some pessimism and caution heading into the year. Mm-hmm. So the facts matter, but also how markets are set, what perception of the world is being discounted into market pricing. And it's that sort of backdrop that has created, as you said, quite rightly, a very strong environment for investment markets in 2024. And stocks, gold, beating bonds, but a lot of good performance across risk assets. And even in the emerging market space, still a situation where stocks are outperforming bonds, which maybe is not what we might have expected at some parts during the year. So for me, it's a combination of a little bit of pessimism and hesitation, but also a set of news flows which were pretty equity friendly over the course of the year.
Yeah, I would agree with that. And I think even though they were equity friendly, you look at sort of the more risk on areas of fixed income, and they delivered quite strong returns. We're looking at really tight spreads across sort of high yield and investment grade credit.
Exactly.
So yeah, really positive year. I mean, we've obviously, Chris, you and I have discussed like the year ahead, and I think you're doing a webinar on it.
We have got one for clients tomorrow, yes.
Yeah, so there's going to be a lot of discussion on that.
We'll be wheeling out the crystal ball in an attempt to predict.
Yeah.
In fact, we were just reviewing some of the ones we said last year. We didn't do too bad, because things about the Fed were expected to cut a lot more than they did. And of course, we got 2 or 3 rate cuts in the end. Of course, you got the 50 basis point bumper one and things like that. Overall, it wasn't a bad year for predictions, but I think it was the strength and also how, as July and August aside, how quiet it was.
Yeah.
how resilient it was. This
It was.
market.
I think I was discussing with, it might have been Angeline or Rich, but the big event last year. I mean, usually you get a couple of crazy events, but it was just really the carry trade one was the one which sort of really threw everyone off. And there wasn't that much.
Well, you had some big shifts in rates, didn't you? But all of that volatility was very much segmented in the rates volatility domain, and it didn't spill over into credits or into stocks in any big way, apart from the yen summer vol episode, as you mentioned, and that's quite remarkable, really. Maybe something to think about for the 2025 scenario, but very much the rhythm of the year.
It's just certainly as you go into this year, it's a question of investors saying, how long can this go on for? A market that seems so resilient, so almost impervious to bad news.
Yeah.
And that in some ways it's maybe got ahead of itself with the Trump election because they're almost trying to replay 2016. There's a question of, can you keep this going in the same way?
I think that's a bit of a it's certainly a bit of a concern because we're looking at, US exceptionalism and sort of how long can it go on for, particularly with US equity markets. And I'm just intrigued to see where HSBC stand on this, because obviously the earnings have been fairly positive coming out of the US, and there hasn't been and the economic data has obviously been fairly positive as well. So it's a really tricky scenario because there's no doubt that US equities are a tad pricey.
Yeah, so you've got a number of almost a few different versions of US exceptionalism here. The GDP exceptionalism, the profits exceptionalism, and then almost the pricing valuation exceptionalism as well, which puts US stocks in a very different situation versus what we see with the valuations in the UK, in Europe, in Japan, emerging or frontier markets. The big set of discrepancies, valuation gaps across those markets. So like you say, what one key question for the new year is the extent to which that exceptionalism repeats itself again. Can these mega trends in AI and the sort of mega theme around deregulation, juicing up the stock market, can that keep on going? One of the big areas that we have been looking at and thinking about, which hasn't really played out yet, is the idea that we see a bigger broadening out story playing on in the stock market. It's happened in phases, but like you mentioned during the summer volatility in 2024, aborting some of the elements of broadening out we'd seen in the earlier part of the summer, toward the end of the year. Again, all about the Magnificent Seven. So that concentration story at the beating heart of US stock market outperformance, the beating heart of US exceptionalism. I guess the open question related to this theme around exceptionalism persisting is the extent to which Europe, Japan, or indeed some of the more value areas of the US equity market, the S&P 493, the other ones that aren't in the Magnificent Seven, whether or not they can sort of catch up. And that works if you see a situation of the soft landing, inflation easing away, continuing to ease away, growth looking okay. But under the more adverse scenarios, bond yields spiking, challenges around growth, or indeed much better news around productivity than the economists are currently expecting, you end up with this concentration story for stock market performance persisting. But I think that's a really big stock market theme for 2025.
Do you think there's complacency among a lot of investors? I was looking at the forecast for the year, and we've gone from, say, late 2022, early 23, saying there will be a US recession. There was that infamous headline of 100% chance of a US recession.
Yeah.
Well, it's now zero.
And now it's now zero. And everyone's, if you look at the consensus is soft landing, no landing, or whatever. Should that be a worry for investors?
Well, I think where we've gotten to is a situation where the market is thinking again of the 2017, 2018 sort of playbook and focusing very much on the deregulation story from the new US administration, focusing around the big story around AI and tech, and maybe some of the more inconvenient truths with what might come through in the policy agenda around tariffs and around the challenges on labour supply, the immigration policies, aren't being sort of fully absorbed. And the honest revelation for why that's the case is we just don't know.
No.
We just don't know how much of what has been talked about on the stump, in the political campaign is really going to be delivered. Should we take Mr. Trump seriously or literally? And that's then the question that the investors, I think, are asking themselves when they're thinking about how to position for some of these developments. But it does create a situation where there's a significant amount of uncertainty about the economic policy outlook as we head into the new year. And for me, ultimately, that means there's going to be more volatility.
Yeah.
It's an argument for being active, being nimble in terms of how we position, because almost certainly the reality that we're going to experience is that this rising amount of policy uncertainty, is anxiety, lack of clarity around trade, the implications for growth, the implications for inflation, how central banks respond, maybe the sort of challenges around tit for tat type behavior from other economies, other countries, that results in a situation of rising volatility in markets and a need to be active.
I thought it was quite interesting that almost people are not assuming they know how to deal with Trump this time, but they're sort of going back to saying, well, we've seen this film before, we know what his favourite topics are, and we're almost able to war game this out. And you get a sense that there was a report in the FT yesterday that China's sort of prepared itself to be aggressive on day one, just as much as Trump has prepared himself to go in hard, and that you could get this kind of volatility arising from that. Both sides are willing to back down.
It's a case of if US, Trump has obviously been very big on tariffs, particularly on China. Are China then going to implement them back in the US? As you said, we're going to get that tit for tat. How much of is that going to sway Trump maybe not to pursue tariffs if there's, internal dialogue between them or aggression between them regarding trade policy?
We see it already in some of the data as well. So there's a number of series that economists build using statistical methods to kind of track newspaper articles and the number of mentions of trade policy uncertainty or economic policy uncertainty. And these metrics, trade policy uncertainty, economic policy uncertainty, are picking up. And so historically, that's kind of gone alongside with more volatility in stock markets, more volatility in credit markets. So this puzzle that we sort of had last year about why all the volatility is constrained to interest rate markets, it's all going on in bonds, nothing much is happening in credits, nothing else, no spillover. Maybe that sort of resolves itself as we go through 2025, where we see maybe fewer questions around rates, the Fed stance, that becomes a bit clearer. Inflation is no longer the key topic of the day. Instead, the key issue is trade, and then how that plays out into global trade, global growth, and the rest of the macro dynamics. So it could be an environment, if that's right, where as you said, the volatility spills over a little bit more into some of those other markets.
Just on the inflation point you mentioned, obviously that's been on our mind for sort of 3-4 years.
Yeah, top of the radar. Yeah.
I mean, do you think we're out the woods fully yet? Because we've still got quite a sticky core, particularly in the US and some of the UK. Do you think there's, a concern if rates are cut too quickly, we then get another spike, or do you think we've seen the worst of it and it's now manageable?
Well, my baseline working assumption would be that we're through the worst of that inflation challenge, and the stickiness that we see, which is mainly in the services inflation when we look at the main economies, that will continue to dissipate over the next few months. Now, one can't be certain about that because it's been a tricky area for economists to forecast and get right. Many careers have been shipwrecked on some inflation forecasts. And of course, we've had a situation in markets where the Fed, the prospect of Fed cuts, aggressive Fed cuts continuing in 2025 has basically been priced out. Yep. Some analysts are now talking about the risk of a 5% long-term treasury yield, which would have significant implications for the economy, but also stock market. Presumably yields matter for the stock market at some point, for the dollar too. So the idea that the Fed could be forced to make an adjustment to policy on the other side, a hike, almost following the playbook that we've seen in Brazil, interestingly, in some of the other emerging markets where fiscal concerns have been the big story. Yeah. We can't rule that out. It could come through inflation. It could come through genuine concerns around the deficit and the level of debt. But that's very much a live risk scenario, I'd say, as we head into 2025. And another reason to maybe maintain a bit of an open mind, accept the reality of quite an uncertain and unusually uncertain economic environment in 2025.
Interesting. No, it's lingered for a while, inflation.
Yeah.
It does seem to want to linger a little bit more.
Yes, it doesn't probably complied as the Fed would like it to. But if you look at how the Fed's performed, I think they'd probably be fairly pleased with how things have turned out so far.
Yeah.
Yeah.
In terms of the economy, in terms of inflation, they're not quite on the magic moment of the soft landing they wanted, but I think marks out of 10 is fairly solid 8 or 9, I think, to be fair.
I think Jerome Powell can give himself a pat on the back.
Lucky rather than good, maybe, but even so, you still get the...
I think we were having this discussion in another episode that it's a really difficult job being a central banker.
Yes.
Certainly
Just
very
better thoughtful than one, yeah.
Another area we sort of mentioned previously is emerging markets and where you see them going this year, different areas of emerging markets.
Yeah, look, I mean, there was the potential toward the end of 2024 that the setup for emerging markets looks really very, very strong heading into 2025. I mean, we had the possibility of a weakening dollar, Fed cuts, falling long bond yields, China policy support, all coming together at the same time that those markets were underloved by investors and exhibiting quite significant discounts in terms of their valuation versus other stock markets around the world. It's not that straightforward, though, at this juncture heading into 2025, because it's not very clear that direction of policy. There's some question marks around that, as we just mentioned, but also we've had this unrelenting strength in the US dollar.
Yeah.
And there's still a question mark in the minds of many investors around what policy support and when the policy support might come in a bigger way, particularly on the fiscal side, from China. But we've also seen some hesitation from the Chinese authorities to cut interest rates because of concerns around what that might do to the currency rate vis-a-vis the US. So both on the China policy support and on the direction of the dollar, there's a few more question marks around that sort of broad backdrop for emerging markets. It makes it a little bit more tricky. I think it's an environment to do your homework.
Yeah.
Maybe sort of looking at more at individual regions or parts of the world. I mean, we still think there's a lot to look at and like in parts of Asia and in frontier.
Yeah.
And one interesting dynamic is some of those emerging markets that have historically been seen as very, very high quality and well liked by popular with investors, such as maybe some of the Central European emerging markets or Latin America, Brazil, for example. They're following more of a kind of a populist, and being more expansionary with fiscal levers at this juncture, whereas some of the more racy, avant-garde, more of the tail in emerging markets are pursuing more conventional policies. So Turkey has really not been an emerging market that many investors have been asking me about as I've been traveling around the world over the last 12 to 18 months. But they're, of course, implementing more and more orthodox policies at this juncture. So there's some of the sinners, Turkey, you think about Argentina as well, are becoming saints.
Yeah, but we were just saying last episode I was in Argentina very recently, and
it's a very interesting situation.
Yeah, it's he's certainly trying to reverse everything that the old style of government was doing, which they've had for a number of years, and seems to be improving certainly.
Well, so what I've been wondering is really whether or not it sets up a situation where country investing and being more country focused, maybe rather than region or factor focused, is going to be a new way to think about these. EM, but even in developed market allocations as well, because what it ends up meaning for investors is that the correlation between Korea and Colombia is very low, and of course it should be low. There's not much of a similarity between them apart from the nice alliteration, the But that may be the situation that we end up moving toward. I mean, we do a lot of work on South Asia, of course. Indonesia and India are super popular allocations among many investors now. But 15 years ago, they were fragile five economies. They've gone from being fragile fives to being superstars. Yeah. So the way that we've been thinking about different parts of emerging markets has really changed quite materially. And I think, again, it points to this idea of being active, but also maybe being a bit selective in some of these allocations, and certainly there's not a quick fire, just buy all of emerging markets solution here. Being a bit more granular, doing the homework is probably the right approach.
We do tend to lump them together, don't we? To talk about the emerging markets as a group, whereas it would be silly. I mean, the same with Europe, though. If you look at the divergence between
Exactly.
France and Germany, clearly there are questions at where that goes.
And if you look at the equity market returns last year, Germany was like the star of the show.
It was always the one that had me scratching my head because it was, given the political backdrop, the awful economic data, the PMI data this morning was dire with the inflation figures, and yet the stock market didn't seem to care, essentially.
Really fascinating situation coming out of Europe there. And yeah, an interesting one, because I think I saw on that your HSBC's outlook that it was slightly underweight to Europe was the house view, if I'm not mistaken. So does that still?
I mean, yeah, look, Europe's on sale, isn't it? And at what point does the catalyst of either stock buybacks or M&A picking up really come in to create a turning point for the stock market? Maybe we're not so far away from that point. We're not quite there yet. So my colleagues, the investment team at HSBC Asset Management, a little bit tentative still on that allocation, but there's no denying that a little bit of good news can be doubly good for that market.
It's tilted enough.
Yeah, it's because of the discount in the valuation, because of how investors are under-allocated, under-focused on that market. Yeah, so definitely worth watching. The problem is the one you've mentioned, which is that as we go into the start of 2025, the cyclical situation, the politics, it's tricky. The short-term situation looks tricky, but definitely something to be watching having on the radar as we move through 2025. And in terms of our house view, we would be looking to reassess that as we go through the year with a view to turning more positive. If we saw the right sort of signals coming into view.
And I think when you talk about undervalued, I think UK comes to mind massively. I mean, it's
fire sale.
Yeah, absolutely. And I mean, do you kind of see a similarity between sort of mainland Europe and, I guess, the UK, the FTSE in general?
It's the same story. I mean, it's the inverse of US exceptionalism, isn't it? So yeah, UK stocks again, very much on sale. Valuations looking attractive. The challenge is thinking in advance of the catalyst that changes that. So again, something that we would be very much looking at, keeping on the radar, but we have a neutral view on UK stocks at the moment.
It's a tricky one because with cheaper markets, you're almost damned if you do, damned if you don't. If you go too overweight, but then the US continues to do well, then you've kind of missed that US rally potentially, and that's what would have happened to many investors throughout 2024 in particular. They would have gone into potentially some regions such as EM or maybe the UK or continental Europe based on the fact that they felt US equities were overvalued, and then they missed.
Well, to be fair, they had a good sort of Q1 for the FTSE 100, and then it didn't really go anywhere. Right? That was the problem. And then normal service resumed, if you like. Everyone went back to buying US. There's a certain weariness among investors. We have to buy US because they do so well, but we have to buy Europe as well because it's cheap. But it just isn't, as you say, delivering that moment that can change the story.
Yes, you need a narrative, and you need then the.
It's all about the marketing, essentially.
It's very much so. So I mean, I guess that element of the points that we made on US exceptionalism. It's not just the strong momentum around profits and growth, but it's the flow of capital from other parts of the world, whether that's Europe or Asia, going to the US. If that either reverses or stops flowing, and the marginal buyers come back to reflect on maybe the valuation story in Europe or the UK or even Japan, parts of frontier, parts of emerging markets, there's quite a few pockets of relative valuation attractiveness around the world. Then the pecking order of returns across markets can shift. And that's the thing to watch for. I guess at this juncture, what we would say is that if we look at Asia, if we look at Japan, if we look at parts of frontier, it's more obvious where the catalyst is.
Yeah.
And it's hard to really back broadening out in a very big way because of how the macro, the geostrategic environment is shifting, and with the policy uncertainties that we've already mentioned. So I would focus the allocation, our house view focuses the allocation a bit more on those broadening out stories working in Asia, where we know the Chinese are providing policy support, looking at markets like India or Indonesia as well. Someone like Japan, which continues to look interesting for corporate reform, valuation type stories. The catalysts are there alongside the valuation story.
Yeah.
Whereas when we look at Europe, we see a very compelling valuation story,
But there's no.
but we haven't quite got a situation where the ECB is very, very far ahead of the curve, or you've got some turning point in terms of macro or profits, or maybe an M&A cycle really, really coming back in a bigger way. When that happens, that's the sort of piece of news.
Would you argue that given Trump's election, there's been more of a catalyst in smaller cap stocks, given the fact that he's, wanting to deregulate and he's very pro-growth? And we've seen a bit of a broadening out, particularly towards, I think it was November time, we saw a huge rally across the Russell. Do you think that that's a compelling area for investors?
It seems to have petered out a little bit toward the end of the year, doesn't it? I mean, I agree with what you say, Aaron, completely, but it does seem to have petered out a little bit toward the end of the year. One of the paradoxes about the deregulation theme is although a lot of investors talk about it, it seems right when you look at the policy agenda, it's kind of hard to find evidence of it in markets. So yes, I mean, I think you're right that you can see the broadening out story as a case of US versus the rest of the world. And that trade, which has been all about the US, then reversing or sort of tilting back to a more normal balance. Or you can also see it as a case of the Magnificent Seven versus the rest, the big caps versus the small caps, even growth versus value, or momentum versus value, maybe. You can see an element of that reversing the other way. But of course, situation is very unclear. So, having those views in mind is, I think, the right way to think about them. But we want to be a little bit careful at this juncture about how bold we are on betting on those outcomes.
Yeah, totally. I mean, we added a little bit to small caps around that time across our portfolios, but we did it in really on the margins, precisely for that reason, just for that extra diversification. But we knew that we're adding a ton of volatility. That both upside and downside. So we only did it in our two most aggressive portfolios and in a small measure.
And it does still feel that small caps are a high beta, and then so you are not necessarily finding something that is mitigating risk in the portfolio necessarily. It's not like you can make an argument, I think, which is quite interesting, that some allocations in parts of emerging markets maybe are even a bit defensive. They're unloved, slightly different economic cycle, slightly different political economic cycle. Maybe Japan is a little bit different because of the yen, as well as the equity market valuations. So having the currency and the stock market exposures together from the perspective of a sterling or a euro-based investor has some quite interesting portfolio properties. It's not clear to me that you can make that argument on small cap. It could work very well, but it might just be adding a little bit more equity risk into portfolios. And if growth does disappoint, if the challenge around tariffs, the sort of supply side shock from that becomes a bigger thing, then some of those small cap stocks
become more heavily affected.
It's not obviously they're not obviously safe haven.
No,
exactly.
No, far from it. I mean, obviously there's a lot to look for in 2020 and 2025, not 2023. I mean, what is, I'd say, keeping you awake? What's the one thing keeping you awake at night going into the year?
More than one thing, I suppose.
Well, I think it's this question around what happens with the politics. I mean, so often I've spent maybe my career thinking about growth and profits and the default cycle and central banks. But we're in a situation now where fiscal policy is playing a much bigger role, a more active role. Industrial policy is really back in a big way. And so I think the big question is that tug of war between the sort of economic situation, but also the politics, and how political uncertainty, geopolitical competition really plays out in the context of markets. I think that's the big question for investors, and it has such a big bearing on the macroeconomic outlook. I mean, maybe it's all fine. Maybe the stock market and bond market vigilantes control the policymakers, and we're worrying about nothing. But the problem as an asset allocator at this juncture is that the distribution of outcomes is just really wide. I mean, like many strategists that you probably have on the podcast, we run a few scenarios as part of our investment outlook, a sort of a central scenario, a downside scenario, an upside scenario. But that even that free-form way of thinking about scenarios is really quite limiting because you can only have a small range of the probability.
You could have a black swan event, which could completely. I mean, 2020 it would have been thrown everyone off the ball a little bit, being like, well, we didn't predict for a pandemic.
Or 22 with the Russian invasion.
That's right. Yeah. So you've got this almost like uniform probability distribution, which is pretty wide, and there are a lot of, as you say, black swans. We sometimes talk about grey rhinos. You know that one?
That's a new one.
The grey rhino is something that's there. You can see it, right? The rhino is massive, is there. You just don't know when it's going to charge, right? So it's more of a risk you're aware of and conscious of, something you can put into your scenario analyzer, but you just don't know when it's going to crystallize to be a genuine threat. One. You can think of a few examples, I'm sure, but maybe to leave it on a happier note, there are some things that could go really right as well, right? So, and this is the challenge with the current environment, not necessarily that we've got a central scenario and then a big left-hand tail where things can go wrong, but there's a very viable argument that says, well, you can see the improvement in productivity everywhere apart from in the economic statistics. We can see the strength of the Magnificent Seven. We can't see labour force productivity really improving that much in the economic data, but maybe that comes through. Exactly. Maybe we see a bigger start of something really happening across the AI, across the healthcare areas, which create a better cadence for developed economies across the board. And that plays into US exceptionalism probably more than anything else. But the rising tide, of course, helps everybody.
Yeah, lifts all boats. Yeah.
So the challenge really is that you've got some left tail surprises that could come through, both known and unknown, but you've also got some right tail surprises also. And that's why I say it's not necessarily a really negative market view, because you can stay positive. There's a few things that could go right, but it's just very hard and tricky as an investor because you've got this unusual level of uncertainty and maybe
it's a little bit misty.
It's a foggy crystal ball. Yeah, exactly.
It's interesting because I think a lot of when you talk about outlooks for the year, a lot of it always focuses on here's what could go wrong next year. Do you find it harder to tell investors there are things that could go right? Do you often find that, especially after 2 years of big gains, do you think that's a harder story to sell because you don't want to sound Panglossian or too?
Well, you sound like a used car salesman, don't you? You sound like you're just sort of selling the product range, and it's a lot easier to sound credible and thoughtful if we're economists or strategists are a bit negative, a bit doom and gloom. It sounds somehow profound.
Yeah.
but yeah, the interesting thing about the current situation is that there are a couple of obvious scenarios where things could go really right. Now, the challenge for investors is a lot of that news presumably is quite well known and priced in, particularly when we look at the pricing of Mag 7 names. And the stock market has been heavily concentrated. We haven't seen those spillovers like you talked about in terms of the rest of the US market. So it's always important to think not just about the economics, but about how the market pricing is set as well. But yes, exactly like you say. Important to be hopeful this time of the year. We've got to keep our New Year's resolutions, haven't we? So, worthwhile reminding ourselves that there are some things that could go right, and maybe investors could be surprised positively with how resilient growth is, maybe with how well-behaved inflation is, and maybe some of the market vigilantes, if we like, marshal the policymakers in the US, in Europe.
They spook them into towing the line, essentially.
Or to stimulate more in the case of Asia. So that's maybe a more sort of hopeful interpretation. Yeah,
it's a good way of looking at it. I feel more hopeful for the year.
Yes, yes. I've my sentiments improved slightly.
Well, I think it's a much better way to look at it because in the same way that we often tell clients markets go up and down, not up or down. good things can happen as well as bad things. A year is not one or the other most of the time, is it?
No. I think there's a lot to keep our eye on next year, or this year, I should say, and it should be quite exciting. So, I think it's time for On This Day.
Yes.
Yes.
First one of the year. You to kick off?
I'll kick off. So, 1540, Henry VIII marries Anne of Cleves.
That went well. That went really well, didn't it?
Yeah.
That's the one with the painting, isn't it?
Yes, it is. It is. It's the 6th of January, by the way, if you're listening at a future date. 1912, New Mexico is admitted to the Union as the 47th state. 3 more after. I can't name them. Chris, you'll probably be.
No, don't make me name them now. I'll panic now. Alaska, Hawaii, and one more, surely.
Yeah, that's what I was thinking as well, but I couldn't think of the last.
No. You can hear the listeners screaming at the radios.
1950, the United Kingdom recognises the People's Republic of China for the first time. So it's on a
quite early.
very important note for the emerging markets for this podcast.
Yeah.
The theme repeats itself. Do you have any this week?
Just the one, 1492 is the fall of Granada in Spain, which is supposed to be the end of what they called it used to be called the Reconquista of Spain, when the Europeans take over from the Moors, if you like. But it's sort of viewed as the end of the medieval period, because it's the same year of Columbus leaving, and it's that kind of hinge, if you like, in history between the end of one and the beginning of the exploration of the New World.
Interesting.
And that's your year. And of course, we couldn't not mention 6th of January, which was 4 years ago now. Is it 4 years ago?
Oh, yes.
The infamous, of course, storming of the Capitol.
Oh yes, that was this day. Yeah, seems like it was only about a year ago.
Yeah, I know exactly.
Blown by. But yes, that concludes today's podcast. Thank you so much, Joe, for taking the time out and joining us.
No, great fun.
And thanks for listening, everyone. And we look forward to seeing you again next time.
May you all spot the grey rhinos in the year ahead. Thank you.
Thank you.